Hello, beautiful people, and welcome to this week's edition of the ITU Forex class. In today's class, we are going to be talking about regular divergence. So, regular divergence, basically, without wasting any more of your precious time, is a phenomenon where traders use a particular set of technical indicators to identify trading opportunities in the market. And this group or this category of technical indicators are known as oscillators, okay? So let me quickly show that to you. So as you can see, I'm inside MetaTrader 5, and when you click on the Inserts tab, you're going to see under indicators, we've got a category for trend indicators, oscillators, volume, and Bill Williams and custom indicators. I'm actually talking about the indicators which fall in this category, okay? The oscillators indicators. Now, basically, any one of the indicators here, well, most of them, I would say, can be used as indicators for identifying divergences within the markets. But divergence is broken down into two specific type of divergence. We've got the regular divergence and we've got the hidden divergence. Now, the regular divergence is the one we're going to be talking about today, and I'm going to be using the RSI indicator, that's the relative strength index indicator, as an example for you. But you could basically use any other oscillator like the MACD oscillator, the stochastics, or any one of them to trade divergences, because basically what these oscillators do is they try to show you momentum of price movement within the markets. And the momentum, depending on whether it's increasing or decreasing in the markets, divergence aims at taking advantage of that phenomenon, okay, to trade within the markets, okay? So basically I've been running around here. Let me quickly give you an example for you to understand exactly what divergence trading is and how to take advantage of it, okay? So let's go to the whiteboard quickly. So basically, the way oscillators work is, most of them, you're going to have a high point. Let me pick my pen, okay? You're going to have a high point and a low point, which is kind of like an overbought and an oversold area on the price chart, okay? So if I pick this and I draw this, when you've got an oscillator, for example, like the RSI, what you're usually going to find is that in the indicators window, you could have the RSI moving like this, okay, within a within its window. But then you would have regions on the RSI, okay? Let's say this is the 100 region, and let me quickly. I need to clean this up, okay? So let me pick this and clean this up. Okay. So this extreme line over here should be something like the 100 price level, okay? Not price level, 100 reading of the indicator. And this should be 0. So basically the way oscillators work is the indicator itself, the line of the oscillator indicator, kind of it rotates. It goes either up or down depending on the momentum within the market, okay? And these other lines that you see me draw here, most traders use them as overbought or oversold indicators, levels on the charts, okay? So some traders use the 20 level to mark whenever the oscillator goes below 20, they regard that as an oversold condition in the market. And some traders use 80 or 70. I'm using 30 and 70 for this particular example. That's 30 and 70 of the oscillator reading to determine overbought and oversold conditions within the market. Now, if price were to come the indicator, the oscillator, was to come all the way over above this 70 region, most traders would take that as a reading that price is overbought. But this is not the way you want to use oscillators, if I would say that. Because the idea is, you see, when price is moving up, last week we talked about market structure. And what you would find out is that if price is in an uptrend, like I told you, most times you'd see price making higher highs and higher lows. Higher highs, higher lows, higher highs and higher lows, okay? Now, when this phenomenon happens, most times because of the strength of the move in the market, the bullish move in the market, when the market is in an uptrend, when price, you could see that maybe price would be somewhere around here, okay, as an example, or somewhere around here, and the oscillator reading might be above the 70% mark, okay? this would be telling you that, okay, this market is overbought. But if there's anything you should know in the market is that there's nothing like price is overbought or oversold, in the sense that, okay, since price is overbought, it's just going to stop and reverse and move to the opposite direction. No, because for whatever reason, if you've been trading for a minute, you probably know that when price wants to move, and when there's a very strong trend in the market, price is going to move regardless of what indicators are telling you. So if there's a very strong trend in the market, just because you see that the oscillator or whatever indicator you're using goes above its overbought reading on the chart, that doesn't mean that price is just going to respect the indicator, and just because it says it's overbought, it's just going to reverse and start moving in the opposite side. In fact, there are times when you see that the oscillator will show you that price is overbought, and you will stay here for a long while because price will just keep going up and up and up and up and up, not even paying attention to what the oscillator reading is. Okay, so for example, some traders, especially counter trend traders, they tend to use and this is not a bad way to trade, it's just you should know what you are getting yourself into. Okay, so if, for example, you're a counter trend trader and you want to use an oscillator not to identify divergences in the market, but you're basically using it as an indicator that whenever it goes overbought, you're going to buy whatever instrument you're trading, for example, or you're going to sell it, then you should do that with proper risk management in place, so that, like, I always tell you about this about trading, you're not going to win 100% of the trades you take, regardless of the trading strategy you choose to use. So you should work out your risk management in such a way that even when you're wrong, or even if you're wrong more than you're right, okay, you're going to have a risk management which would help you to be able to profit from the little winning trades you get, so that that's not going to spoil your bottom line, okay? But again, this is not the way we're going to be using oscillators. What I mean is, we're not going to be using oscillators in a way that when they go above the overbought reading, we're just going to sell, thinking that, okay, since the oscillator says price is overbought, it's now going to start going down. That's not the way we're going to use it. Again, the other example of this is, we're not going to be buying when the oversold indicator, when the oversold level of the oscillator indicator shows us that price is oversold. Because even though the oscillator might show us that price is overbought or oversold, price can keep moving in the direction that the oscillator is saying is overbought or oversold, paying no attention to it, especially if there's a strong trend in the market. Okay, now with this briefing out of the way, let's quickly go to the charts so that you can see crystal clear examples of this in action. So, like I told you earlier on, the way oscillators work is they try to mimic what is happening on the price chart. So what do I mean by they try to mimic what is happening on the price chart? Ideally, when price is moving, for example, in a downtrend, when price makes a new high, the idea is that the oscillator should also follow price and make a new high. A new low in this example. We're using this as a new low. Okay? So price moved from all the way up here to all the way down here. And you can see that the oscillator also moved from all the way up here to all the way down here. Now, price did a little bit of retracement. It pulled back. It didn't go all the way back up here. And you can see that the oscillator also went back. It retraced its steps, and it didn't move all the way up here. So in an ideal condition, this is exactly what we want to see be the relationship between price and the oscillator. So whenever price makes a new high, the oscillator should also make a new high. Whenever price makes a new low, the oscillator should also make a new low. Whenever price makes a high which is not as high as the previous high, okay, then the oscillator should also mimic price and do that same thing, form a high which isn't as high as the previous high on the oscillator. Now, if price and oscillators continue doing this, we're never going to have divergence because they are in agreement with each other. But when price does one thing, or when price tells you one thing and the oscillator does another, that is when we have divergence in the market. So let me show you a quick example of this. You see, price again made a lower high here, then it went all the way down to form a brand new low, okay? But as you can see from this diagram here, that price just barely, just like it did on the chart, price just barely formed, the oscillator line, the line of the oscillator, it just barely formed a low, just like price just, barely created a low that is lower than the previous low here. So price and the oscillator are agreeing with each other. Again, price made a lower high. You see, this high that price made is not as high as the previous high because obviously this is a downtrending market structure, as you can see. And then the oscillator did the same thing. It made a lower high that isn't as quite as high as the previous one. Now, price broke all the way down below this low, okay, to form this low all the way down here, okay? And the oscillator did what? The oscillator did the same thing, okay? Now, like I told you, this is what an agreement or an alignment between the oscillator and price action. This is what it's supposed to be in an ideal market condition. But when the oscillator forms a lower low, but then price forms a higher low, then price is basically the momentum, the strength of the move in the direction of the trend that you're seeing. The oscillator is basically telling you when there's a divergence that price it's not moving as fast as it used to, and so there's probably less volume in the markets to continue moving price in that direction that it was moving. So a reversal might just be around the corner. That's all that an oscillator is telling you. That's all that divergence is. And you can see that when price formed this low here, when it pulled back, you can see it pulled back here, and then it formed a lower low. But then price now did this. It came all the way down here and formed a low which is lower than this previous low. But what did the oscillator do here? The oscillator formed a low that is higher than the previous low. So you can see the oscillator is saying one thing. When you connect the 2 points of the oscillator, the levels, it's slanting up, while when you connect the 2 points of price action, it's slanting down. This is what a regular divergence is called. This is what is referred to as a regular divergence. Why? Because price is moving down, but the oscillator is not agreeing with what price is doing and following it to make another brand new lower low on the oscillator's reading, but rather is doing the opposite. This is what is called divergence. Okay, so when you see this in the market, when the oscillator is making lower lows, when price is forming lower lows and lower highs, but the oscillator is forming higher lows, then this is what regular divergence is. This is a regular bullish divergence. What's it telling you? Whenever you see this on the chart, what is it telling you? It's simply telling you that price is the momentum behind price that was pushing prices lower with strength previously, okay? It's beginning to weaken because in the past, maybe it took you only, 5 candles to move like 100 pips from all the way up here. This is just an example to all the way down here. But now you've got a phenomenon on the price chart. I'm just basically telling you what this oscillator uses for calculation, okay? How it gets its number. So it's basically telling you that in the past, when the trend was very strong, we had like 5 candlesticks or 6 or 7, depending on how many candlesticks we have here. They moved from all the way up here to all the way down here, which is like a 100 pip move, for example, within just 5 hours. But then now they moved just, maybe half of that move, maybe like 50 pips. And it took it way longer to form this move. Maybe it took it like 8 candles or whatever to form this same move. So in the past, the trend was very strong, but now it's not moving as strong as it used to, and it's even taking more time to do that. That's what this particular indicator is telling you. It's just measuring the momentum of a price move in the market. So it's basically telling you that, look, there seems to be a weakness in this trend. And just like anything in technical analysis or anything in trading, this is not a certainty that when you see a divergence on the chart, it's telling you that, okay, you've seen a divergence, price is definitely going to move up right now. No. It's just telling you that there's a weakness in the market. And so if you want to take advantage of this opportunity and you want to take advantage of it now, you could simply, take a buy trade here, place your stop loss below the level, and, go for good risk to reward ratios like 1:1 or 1:2. Risk 1% of your account's capital per trade. In this case, if price does what you anticipated it was going to do, and you take the trade, it hits your profit target, then you make maybe 2 or 3 times what you're risking, depending on the risk to reward ratio you took when you took the trade. But if price proves you wrong and hits your stop loss, big deal. You only lost 1% of your account's capital. If you keep trading like this with proper risk management and good risk to reward ratios, even if you were to lose like 60 out of 100 trades that you take, eventually you still come up with profits. Because your average profit winning trade is bringing in more profits than your average losing trade. That's just what trading is. when you see this type of setups on the chart, it's not telling you with 100% certainty that price is going to reverse. It's basically telling you that there's an indication that price might reverse based on what is being displayed by the price action on the chart. That's basically what this is telling you. Okay, so let's look at more examples. And before we move on, I would like to do this quickly. So we identified divergence here. Why? Because price was forming lower lows, okay, and the oscillator here was forming higher lows. So if you're somebody who just immediately you spot, there are different ways to enter a trade when you spot divergence, okay? There are traders that as soon as they spot that divergence, they're just going to place the trade with their stop loss and their take profit, just like I told you, with proper risk to reward ratio. That's one way to go about it. There's no right or wrong approach. You just pick and choose what works for you. And other traders don't rush into the market with taking trades about divergence like that. What do I mean by they don't rush into the markets? You see, let's go to the whiteboard. Let me show you something. Let me quickly click on this, okay? So if you'd remember, and since it's a red thing, let's use this. If you'd remember, I told you that when the market is in an uptrend, the market structure of an uptrending market is that price is going to form higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. But then this trend is not going to continue indefinitely. There's definitely going to come a point in time when price is going to find it difficult to continue forming these higher highs and higher lows. And so when that happens, either price is going to just start barely breaking above the previous resistance or forming a high that is just maybe as high as the previous resistance or not even as high enough as the previous resistance. But the trend is not going to continue indefinitely where price is just going to continually form higher highs and higher lows, higher highs and higher lows infinitely, okay? It's not going to happen like that. Now, what price action do we need to see on the charts or in the market for us to know that, okay, this particular trend that we have, this particular bullish trend that we had in the past is likely that it's over or maybe it's just taking a pause in the market for now? What do we need to see on the charts for us to say that? Well, we need to see that price is finding difficult to break above previous resistance areas significantly, and we need to see that price, all of a sudden, price that wasn't even testing the previous higher lows, we need to see that price comes all the way up here to break a higher low and now try to continue forming higher highs but fail to do that, fail to even test. It could test the previous resistance, but then it's not going to be able to break above it to continue forming higher highs and higher lows. When we see this, then we know that the market structure of our uptrending market is no longer intact, it's no longer in place. So we went from forming higher highs and higher lows to now forming lower lows and lower highs, meaning for this particular example, we've gone from an uptrending market to a downtrending market formation. Now, the way some traders like to use divergence is that, you see, when price is finding it difficult to break above these previous highs, okay, if you're using an oscillator which is showing you divergence, regular divergence in the market, most times what you're going to see is that when I draw this as an example, okay, most times what you're going to see on the chart is that the oscillator is going to form a high and then it's going to pull back just like price pulled back. But then when this price forms a high which is just barely above this previous high, the oscillator is not going to be able to form equal highs or even a high that is as high as the previous high on the oscillator reading. Okay, and so you're going to have a downward sloping line when you connect these two levels or these 2 points on the oscillator, while you have something like an upward sloping line or a equal line, okay, equal heights line, horizontal line, when you connect the points on the price action. Now, like I told you, some traders, as soon as they see this and they see a divergence in the price on price action, once they see a bearish engulfing candlestick or a hammer candlestick, any candlestick that is showing them that momentum has shifted from the bulls being in control of the market to now the bears taking over control, then one trader is going to place a trade here, place his stop loss here, and maybe go for a 1:2 or 1:2 risk to reward ratio. But other traders who are more conservative traders, the type of trader that would place a trade here when the divergence has just formed without waiting for any confirmation, is usually an aggressive trader. Because he doesn't mind that he's taking the trade now and then price just reverses and continue making high highs and high lows. He'll just take his loss and, you know what, I wasn't right on this call. It's no big deal as long as I'm practicing proper risk and money management. But there's a more conservative trader who would like to wait for a confirmation by price itself. So for that conservative trader, when he spots divergence on the chart, he's going to tell himself that, you know what, we still have the anatomy of an uptrending market here, assuming that price hasn't broken below this higher low. So price just formed the divergence, and then this trader is going to be saying to himself that, you see, and in an uptrending market, the anatomy is that price is going to be forming higher highs and higher lows, higher highs and higher lows. So just because price barely broke above this previous high, it still hasn't broken above below this higher low. And because of that, we still have the makings of an uptrending market. But then when price is able to break below this higher low, and then it's going to pull back and fail to form a high which is higher than this previous high, this particular conservative trader would say, you know what, we've now shifted from forming the market structure of an uptrending market to now forming the market structure of a downtrending market, because in a downtrending market, price is going to be forming lower lows and lower highs, lower lows and lower highs. So we've now formed this. So for that trader, when this happens, when the market structure has shifted from the market structure of an uptrending market to the market structure of a downtrending market, that trader is going to be like, yes, now I have confirmation, and now I'm going to take a trade here, and then I'll place my stop loss above this level, because if for whatever reason price triggers me into this trade, but then goes all the way up here to break above this previous high levels, then we are no longer having the market structure of a downtrending market, which is signified by the formation of lower lows and lower highs. So he's going to take the trade here, place a stop loss above this area, because when price comes here, his trade setup would have been invalidated, and then he'll go for a risk to reward ratio of maybe 1:1 or 1:2 or 1:3. Again, I always advise you guys to go for a risk to reward ratio, meaning you're risking 1 to make 2 or 3 at least, because if you're trading like that, even if you were to, let's say you were to take 100 trades, okay, and you were to lose 60 out of the 100 trades you take, you only won 40 trades. That's 40% is your win rate. If you are risking 2, okay, every time you're risking 1, you are aiming to make 2. For the winning trades that you would have a gross profit of how many? 80%. And for the losing trades that you have, because you're risking only 1%, your gross loss would only be 60%. So at the end of the day, when you subtract that 60% from this 80%, you'd still end up with a net profit of 20%. So it's not about being right all the time. No, it's not about that. It's about identifying an edge in the market. In this case, divergence could be your edge, and then trading it with proper risk management, never risking more than 1% of your account capital if you're using a simple linear risk management trading strategy, and then you're only, taking a trade and aiming to make more than you win on average. Okay, it's as simple as that. Now let's go back to the chart so that I can show you an example of using identifying a divergence setup using the market structure break. Okay, so let's quickly do that. Okay, yeah, I need to turn this off. And so moving on, here's an example of the market structure break with divergence. Okay, with divergence trading. So I told you that usually when price is moving, an oscillator is supposed to be doing the exact same thing that price is doing. So in this case, for example, if we're to consider price from all the way up, down here, you can see that we had a low here, and the oscillator also made a low here. Okay, so price moved from all the way up here to here, and the oscillator also moved from all the way up here to here. Okay, now when we take it a step further, you can see that price moved all the way up here, and then the oscillator moved here. But then price now, when it hit this level, it pulled back a little bit, and the oscillator also pulled back a little bit. But then price recovered from this pullback, and it made a high which is higher than this previous high that we had here. And you can see that the oscillator also pulled back. But then when it made this high, that's this high, on price action, on the price chart, this high is higher than this previous high. And by ideally, the oscillator is supposed to also make a high which is higher than its previous high, but it didn't. And so we've got the setup of a divergence here, because price formed higher highs, okay, and higher lows, while the oscillators formed a lower high here. So we've got divergence. Now, the aggressive trader, like I told you, when he sees something like this big bearish engulfing candlestick here, he's just going to take a short trade here with a stop loss above this level, because if price was to break above this level, his trade setup would have been invalidated at that point. But then he's going to be going for maybe a 1:2 risk to reward ratio, or whatever the case might be. Okay? But like I told you, the market structure, the conservative trader is going to wait for the market structure to shift. He's going to wait for the market structure to shift. So you can see that for that to happen, price needs to break below this higher low. So when price broke this level and then it pulled back and it failed to break above this resistance area, that trader, that conservative trader who waits for market structure to confirm his trade setups before taking the divergence trade, would have taken a trade anywhere here and place his stop loss above this level and maybe aim for a 1:2 or 1:3 or whatever the case might be. This is as simple as it gets. So when you have price forming lower lows and lower highs, and then you have the oscillator forming higher highs and higher lows, this is what is known as a regular bullish divergence, because it's an indication that price might reverse to the upside from the downtrend that it's doing, that is making. Or the opposite is when you have price forming higher highs and higher lows. Sorry, let me clear this a little bit. The opposite is when you have price forming higher highs and higher lows. Ideally, you want to see the oscillator also forming higher highs and higher lows. But if for whatever reason the oscillator starts forming lower lows and lower highs, that is a regular bearish divergence, which is just telling you that the momentum, the strength of the bullish move, the trend that we had that was going up is probably, weakening now. And so price might just reverse to the downside. And that's what traders will take advantage of. Some traders, like I told you, as soon as the aggressive traders, as soon as they identify the divergence setup, they're just quickly going to place the trade, place their stop loss above the high of the divergence, the high points that form the divergence in price action, and go for a 1:2 risk reward ratio. Remember, no matter how good the trading strategy is, if you don't use proper risk management, you are going to struggle to become profitable. And that's why, even though divergence works, 40 or 50% of the time, if you don't pair it with good risk reward ratios, good risk management, risking consistently on your accounts, you're going to find it difficult to be profitable. And that's why I always hammer upon risk management in these classes, because no matter how good a trading edge is, if you don't use risk management properly, you are not going to be able to become profitable. And so, whether it's divergence you're using or SMC or whatever the thing is, you need to practice proper risk management, okay? For you to be profitable, you need to have an edge. That's a good trading strategy that will give you an advantage to exploit a tendency which occurs in the market regularly and consistently. Pair that with proper risk management and a psychology that is not going to make you skip taking trades when you get a losing streak because you're scared of losing money, or getting overconfident and risking more than you should because you just had a couple of winners in a row. Okay, so these are things that are all important. Okay, so this pretty much brings us to the end of this week's edition of the ITU Forex class. Again, you should study your charts, go back in time, look at price action on the charts and try to identify these divergences, okay? You're going to do yourself a great service when you identify them on the charts and backtest them and confirm to yourself that they work, okay? But like I told you, you need to do the soul searching by yourself. Are you an aggressive trader who, as soon as you spot a divergence on the chart, you're just going to take a trade, place your stop loss, and aim for a 1:2 or 1:3 risk to reward ratio, depending on your risk tolerance? Or are you the trader who is going to, after you identify a divergence setup, you're going to wait for a market structure shift before you take that trade? Okay? Decide for yourself what kind of trader you are, and then backtest it and to improve your trading performance. Now, before we wrap up this class, I would like to invite you guys to explore our options of ITU bots, which are designed to help you place trades on your behalf and manage those risks and everything that you just learned from here. They'll do it for you on autopilot, okay? So instead of you having to sit in front of the charts, waiting for the trade setups to form, placing your trades by, doing your risk management calculations and everything, do it everything manually. You can take advantage of our ITU bots, which are designed to give you an edge over the market and trade for you while you're out there living your life or doing your part-time job or anything like that, okay? If you're interested in that, reach out to ITU Global or on any of our socials, or you could go to the website and explore our options and basically test them out for yourselves. Once again, I look forward to seeing you guys in next week's edition of the ITU Forex class, where we're going to be talking about the opposite of this regular divergence, which is the hidden divergence. Again, the regular divergence, we take advantage of it to identify turning points in the market. So when the market is in a downtrend, for example, and it's going to be switching to an uptrend, that's where regular divergences work. On the contrary, hidden divergences, which is what we're going to be talking about next week, they actually work in trending market environment. So the market is already trending, and a hidden divergence is going to show you a signal that this particular trend that the market is exhibiting is likely to continue moving in that direction. That's what we're going to be talking about in next week's edition. Again, if you're interested in the bots, reach out to us on the socials, and we'll be more than glad to assist you set everything up step by step. Once again, thank you, and God bless you all. Cheers.